Good evening, everyone. Welcome to the Seattle Angel Meetup. Our session tonight is on Angel Investing 101. We'll be having people join us over the next little bit, but we're going to get started. So excited to have you here. John Seacrest is in Portugal at the moment. He's been doing some discussions with some angel investors on our European front, and happy to hear from him when he comes back about the contacts that he has made here. We're, as part of our run up to our Seattle Angel conference, where we match investors and entrepreneurs together to do an analysis, due diligence screening, and then do a final presentation with the winner. We like to do education sessions for investors who might be, or people who want to understand about angel investing, as well as for entrepreneurs who like to know about what investors might be looking at when they analyze their companies. Today's a day for us to have a little bit of a presentation by Alex Alviar, and I'm going to be introducing him next. And if you have questions that you like, you can put them into the chat box and we'll hold them till the end. I am Elizabeth Cross-Nickel and I work with John. My program that I particularly do is the APIS Health Angels. So if anyone's got a specific interest in health and life sciences, investing and entrepreneurship, then please feel free to connect with me. But I'm happy to talk to you about any other of their programs and talk to you then. All right, so we are going to Alex Alviar. I met when I was in SAC 17, I believe, and we invested together. And Alex has a background in health, and I'm going to let him explain that. But he has done a lot of investing, angel investing, alternate investing, and still maintains a corporate job. And so maybe Alex, you can take it away and talk to us a little bit about your learnings that you've had as you've gone along and what people should be aware of when they decide to get into the space. Thank you.
Awesome. Thank you, Elizabeth. I'll jump in, and I expect it will be maybe about 45 minutes or so. I'm going to try to cover a lot of ground. And this presentation is primarily geared to people who might be thinking about getting into angel investing. And so some of you may have already dabbled in it. Others of you might be brand new to it. So hopefully we'll find something here for everyone. And those of you who are entrepreneurs, welcome. I think getting into the mindset of what angel are looking at and dealing with is one of the more powerful ways to just start thinking about how you connect with them from the other side. So I'm glad to see you guys here as well. Let me just start with a little bit of a brief introduction. I've been investing since 2016, and I have about 22 companies in my portfolio. Keep that number in mind if we'll be talking about diversification and angel investing in a little while, but there's a reason that I tried to get to 22. Investing is not my full-time focus. So that's something for those of you who are kind of going, how much time does it take? Is this something that I can do? Just know that it's never been my full-time focus. Even right now, as I'll be stepping into a fund manager role, that's still not my full-time focus. So angel investing is something that often attracts people who are in retirement age, and it does take some time, but it's also something that professionals can do and balance in their time, because there's an entire range of options in terms of how active you can choose to be with your investment. So some people really get into it, other people a little bit more passive investors, and we'll talk about that too. And then finally, by way of full disclosure, I'm the fund manager for the upcoming Seattle Angel Conference. So I'll talk a little bit about that and how it fits potentially into an angel investing journey. The primary focus of my presentation today is just to give you some nuts and bolts that will hopefully be helpful for you, regardless of where you decide to take your angel investing. All right, so let me jump into that and kind of cover with you what I'm going to cover on a really high level. I'm going to cover a little bit on the basics about who can be an angel investor. If you haven't done it before, it can be daunting. You think maybe it's someone that had more experience than you do, and I'll tell you straight off the bat, it is engineers, it is doctors, it is people from a very diverse set of backgrounds, as you saw from some of the introduction earlier. Then I'll talk a little bit about how the investment actually happens. the nuts and bolts, the steps, and where it fits into the continuum of how companies raise money. And then we'll talk a little bit about the key activity. So if I were to sit down as an angel investor, what am I actually doing day to day? So I'll review them with that. And then at the very end, I'll just recap some of my perspective as to why some angel investors are more successful than others and what you might want to consider before you decide to jump into it. Okay, so first, a real high-level caveat. This is my personal perspective. It is vastly oversimplified, and it's not meant to be taken as financial advice. So I'm happy to kind of answer questions and engage with some of you offline. And I may not have all the answer, but hopefully I can point you to someone who might have some more in-depth perspective on a particular question you have. But again, just keep in mind, there are lots of different ways that people do angel investing. This is just a reflection of my journey, what I learned, and what I wish I knew when I started back in 2016. If you're interested in additional resources, I just want to leave you with a few of them, and perhaps Tessie or often someone could type these into the chat. That would be great. But there's a book by David Rose called Angel Investing that kind of covers a lot of ground here. There's another book by Noam Wasserman called The Founder's Dilemma. That one gives you a little bit of perspective more from the company side, but it touches a lot on how they do fundraising. Paul Graham is a great person to follow on Twitter, and videos like this one show up on the Seattle Angel Conference YouTube website. So there's a whole bunch of resources there that you can look into as well on a variety of different topics. Okay, let's just start with who can be an angel investor. So first thing, just really quickly to get out of the way, there is actually a legal definition of who can be an angel investor. And it's written there on the right side of the screen there. Basically, it had to be individual for your net worth is over $1 million, not including your primary house, or you're making about $200,000 a year. What's interesting about it is that is the statute of what's required, but there's actually very little validation that occurs in the industry around that. A lot of it is really self-attesting that you meet those requirements. And the reason the government had these expectations in place is because they want to make sure that people are not exposing themselves needlessly to too much risk. So in other words, you need a certain amount of assets to be able to lose a certain amount of assets. These are high risk investments. Diversification is important, so you have to be able to allocate a certain amount of money over time to truly actually get a good return for your money. And I'll cover that in a minute. In general, there might be some presumption in the law that wealthier people are a little bit more exposed to a lot of things like operation, management, finances, etc., at least on some level. But as long as you meet this definition, you can be an angel investor. So the other way to think about the question is who can be an angel investor? I would define it as, people that can provide value to our entrepreneurial ecosystem in a variety of different ways. Most obvious is to invest in their dollars, right? Companies need money to do what they do. But some of the more understated ways and make them what makes angel investors a little different than maybe some later stage investors in some cases, is they're also lending a very personal level of expertise. So you may think, well, I only know this much of the corner of the universe. But angel collectively into a network actually probably knows somebody who knows somebody who knows something about that. And that's one of the more powerful ways that I think company can learn from angel investors. You get a perspective on things that someone has some expertise in. The other thing is angel investors are networkers. Even if you're not a big networker yourself, chances are even someone who might work at this other kind of company and say, hey, you should talk to so-and-so. And the more that angels get into an angel investing through programs like the Seattle Angel Conference, the more they get to know people. I met Elizabeth many years ago, and she is always in the back of my mind in terms of, hey, this is someone who knows healthcare. This is someone who knows investing. This is a fantastic moderator who works with people well and brings them together very, very effectively. She knows social media. So I have all of that kind of thing kind of clicking through the back of my mind. And the more you get into angel investing, the more you kind of think about that. And there's a lot of value in providing those networks for people that are starting out in a company. And then finally, and this is one of my favorite parts, this is why I do the fund management aspect. It's hard. It's hard being a company, right? You're often working in a solitary environment, or at least with a few other people, facing a lot of rejection. Even the successful companies here know a lot. And angel investors usually go into this from a little bit of place of a heart. They want to be helpful, or you should want to be helpful. And so providing encouragement, but also honest feedback, I think is a really, on a personalized level, it's a real unique way that angel investors provide value. I found that most of the angel investors I talk to, they want to help. They want to be positive. They're not like Mr. Wonderful on Shark Tank, who's just like, hey, I just want to make money. These are people who are drawn to this because they enjoy the personal aspect to some degree of helping build people up. So this is another way to think about it. If you have an interest in all of these different things, you also could become an angel investor. So let's switch gears and talk a little bit about how the process itself actually works. So I want to give you a little bit of a high level ground here. Companies usually go through several stages, right? You have a concept, you move into MVP or minimally viable product. Maybe you've got a pilot, you have some early traction saying I've got 2, paying customers. Then you start to scale the business. You say, now I've demonstrated that I can get multiple paying customers, or I've demonstrated that I can sell and market the product on a broader scale. And then more traction. And then eventually, perhaps you might get to an exit, which would be an IPO or someone buys you out. So along the spectrum, on the left side, you got, the highest risk, but people who jump in, provide investment at that point, get the highest returns. And on the right side, you got the lowest risk and lowest returns. And so if we were to break this out, this is really oversimplified, but this is how I think about it. When you have the first step is really you've got friends and family. You have people kind of making investments, really just to help get an idea off the ground. Angel investing comes in this early stage in between where maybe the company had demonstrated they got some early potential, but they're still very much in a pilot phase in many ways. They might not have a full team yet. They are looking to learn, and typically companies at that stage end up in a slightly different place down the line where they start. So they need a lot of people who kind of believe in the vision and have creativity to partner with, to say, I don't know exactly where we're going, but I believe that there's some potential here. And then after that, you get into venture capital, which tends to be a little bit more to a larger organization. They expect a certain amount of discipline. They are a little bit more focused on the returns that the organization can get. And so it can get a little bit less personal, a little bit more disciplined at that point. But what's important for you to realize, if you don't already, is that angel investing is what we call typically in the seed round. And the way that those investments happen is through typically, and I'll cover this at the end, something called a convertible note or SAFE. What that means is that it's kind of a promise for saying when your company gets valued in the future, my investment will get converted into shares in that value. But we don't know exactly what the value of the company is at this point. When you get to called a Series A, B, C, and so forth, that's where the company is actually valued, and every share has a certain value attached to it. And so the convertible notes or SAFEs that angel investors make get converted into something that's of value, that eventually when there's an exit or a buyout, everyone gets paid out. So on a high level, that's how it works. I will revisit this to what that looks like in the seed round, but a couple of things I want to kind of maybe point out about what it means is that, about what all of this means. First of all, some companies actually, especially in the seed round, where they kind of are getting a promise for a future evaluation, don't ever really get to that point. And so they become, but they're still successful. Maybe they're making $1 million a year. The founder is kind of happy with that, and they never make it to a Series A round. So at that point, they become what's called a zombie. So essentially, the early investor never get to that light blue box in the far right side where they get bought out. So it is high risk in that regard. Not all angel investments fail. Some of them simply just make a low level of income and ride that out. The other thing I would point out is that the reason that these different raises happen for different reasons. Sometimes the Series A's, B's, and C's, they're raising money either because they want to scale the business, or sometimes, like especially right now where the economy's a little soft, it can be just to keep cash flow going to get to the next stage so they can survive until market conditions are better. Typically, for angel investing, that's not the case. Usually you're investing not because someone doesn't have cash flow. Usually at that point, the cash burn is really low. And so what you're investing really to help them get started. And so economic downturn can actually be a really good time for a seed round angel investing, because by the time that they get their product a little bit more solidified, they got that earlier customer feedback, the economy has already changed, and they're ready to move into a Series A round of funding. So hopefully that makes sense in terms of where this would fall. And again, I'll revisit a little bit with convertible note size safe in a moment. It's a lot of acronyms in angel investing. I see questions coming through the chat, and I will answer them at the end. Last thing I want to give you some high-level perspective on here is that each round has a different check size. So what that means is, like, if you're an investor, how much money do you need to have to participate in a round like that? And these are really broad generalization. But generally speaking, like when you have your friends and family, if someone's got even $1,000, yes, we'll take it. You know, we'll just start with something. In angel investing, typically it'll be like $5,000 to $1 million. Now, $1 million may sound like a lot, but that's often like you might have what's called a family office, which is like some very, very rich individual. They've got some money to fund, and so that person will be involved in angel investing. They might be able to write a huge check. But there's also a whole bunch of smaller checks that are written at the $5,000 or $25,000 level that are quite common in angel investing. When you move into venture capital, you're getting to much larger amounts and minimum check sizes. And so typically you're talking about less about individuals and more about family offices and venture capital funds. Okay. So drilling down a little bit more in this, I want to give you some idea as to why those check sizes look the way they do and what that means. This is just a snapshot of what they call the median round size. So the round would be like the seed round or the Series A. And then on the left, that's the other sides of the round. So what that means is that's kind of what this company is saying they want to raise. So they might say, I'm going to really aim to raise $1 million. And the reason that they set an amount is because they're trying to collect a bunch of angel investors to be part of that round. And they need one person to be the lead. That lead helped to set the tone for the round, and then other people attached to that, and then they fill the round. So what you see on the right is like the median investment. So for example, in 2021, the median round was say we wanted to raise $1.3 million. And then the one individual might kind of step in and say, I will provide $800,000 of that amount. Then the remainder of that got filled in by additional investors. So, but this is again medians, smaller, larger investments around the median. Some of you may be wondering kind of what seed angel investment looks like. This is a breakdown of what they were like in 2021 nationally. You can see a lot of them are in IT, less on healthcare, and healthcare quite common too, but you can see all the way to the bottom of biotechnology, because lots of times angel investors are looking for a return in like the 5-year horizon. They're also looking for things they can invest in where, you know, even $200,000 for the round can help the company get some play. Whereas, you know, industries like biotechnology and energy often take much larger upfront investments and much longer period for the return. So that's why you see them in a different category to some extent. All right, so let's break down a little bit more about how this investment actually happens. So I talked earlier about how a bunch of, you know, angel investors will come together and they form an investment in a particular round, a seed round. On an individual level, there's a bunch of ways that happens. One is a direct deal. So in other words, I saw a company that made an ultrasound device for looking at ear infections, and I was like, that looks really interesting. So I talked with the founder and they said, we're doing a round right now. We'd love to have you join it. The minimum check that we need is $25,000 or $50,000. So it tends to be a large check that you have to write to one company. So typically this is off limits unless you have a lot of wealth and you can afford to write lots of single $25,000 or $50,000 checks. The other way that angels will kind of get in is they become what's called a limited partner in a fund. So a fund is formed, and I listed a couple of the names of some of the ones in our area here. And they say to the people who are interested in angel investing, if you'd like to join the fund, we have a minimum check size of $25,000 to $50,000, but we're going to pool, say, $5 million from a bunch of people writing those checks. And then we're going to take that $5 million and we're going to invest in a bunch of companies over the course of a year until the money runs out. Now, this is a little different from direct deal because with a direct deal, you're putting, say, $25,000 or $50,000 in one company. As a limited partner, you're putting $25,000 to $50,000, but it's getting spread out, say, over 10 companies. So for the same amount of money, you get more diversification. And then the limited partners in a fund, they operate in different ways. You know, like sea change, the participants will actually vote on whether or not they want to put money in a particular investment. In other funds and so forth, the money put in there, they might talk to the investor, but the decision is ultimately that of the fund manager. So every fund's a little bit different. The third bucket here is basically syndicate deals. What that means is it's basically a collection of friends who say, let's go and invest in it, or a collection of investors. So for example, this your company that I mentioned. I say, hey, look, I think this is a great company. I can't write a $25,000 check, but let me see if I can form a limited liability partnership. And then I will talk to a bunch of investors.
Hi guys,
Through my network.
how you doing today? You doing good, Wookie, today?
I'll talk to a whole bunch of my network, and then each one, and I'll tell them, look, if you each write a $5,000 check, a $25,000 check, I think I can raise the $50,000 or the $100,000 that will get this company to take a direct deal. So instead of the direct deal happening with me as an individual, it's happening with me as the lead of a limited liability partnership that I've formed. So in a way, it's kind of like getting to direct deals, just kind of structuring it to be the person who takes the lead of making that happen. But the check is written to a single company. People often find these through lists like Angel List, Gust, or SPVs, or special purpose vehicle. There are companies that will help you actually set up an LLC for this purpose and handle a lot of the legal paperwork. So once you get into it, it's not that complicated, but it does take somebody willing to be the lead to create the syndicate for the investment. And then the final one I just listed out here, Seattle Angel Conference, just to put this in some perspective, is basically a special purpose vehicle that's been put together to invest in one company. So I want to talk about that just a little bit briefly because it might help to tie together all these things we're talking about. So Seattle Angel Conference, for example, has been around 10 years. So twice a year, they'll get a group of investors together, 20 to 40 investors, and they'll say, let's invest in one company. Now, instead of identifying that company, what they do is they run a contest to determine what that company is going to be. And then they form a limited liability partnership and pool everyone's money together to make an investment in that one company. So it's basically a syndicate of some sort. What makes it a little bit different from some of the other funds around is that it's designed specifically to allow people to get into learning about investing with a relatively low check size. So I believe Sea Change has like a $50,000 buy-in. We're going to spread that out over maybe 10 companies. But with Seattle Angel Conference, if you've never done investing before, you can write a $5,000 check and you'll get one investment out of it and learn a lot of the process. It's also very much a learn by doing process. And what that means is that we, by design, it gives you exposure to all the companies that have applied. So you see the company to look like they're really exciting as well as the ones that you're saying, why are they even raising funds at this stage? You're going through the due diligence process, which we'll talk about, and you're seeing how the investment comes together. So it's a good way to kind of learn a lot about what I'm talking about here. And I'm not aware of another program, at least in the Northwest, that is quite like it. So that's why I'm involved with it and I get excited about it. We're running on that cohort starting August 30th. So if anybody's interested in that, please let me know. And I would be remiss not to mention that John Seacrest also had now, I think, one that is focused on healthcare called Thesis, and another one that is focused on transatlantic businesses called TAC, TAAC. So if you're interested in those as well, it's a similar structure, just slightly different focus. So putting all of this together, I've seen Angel take several different journeys. Like I said, I've been doing this since 2016. So these are not the only pathway, but some of the pathways I've seen people go from starting their angel investing journey to where they are today. Some people have just dabbled. They said, hey, I have a friend who started a company. They asked me for some money. I said, this looks like a great idea. I've written a check. And that was the introduction without necessarily a lot of broader context or knowledge around that. So for those folks, like going into something like Seattle Angel Conference, where you're kind of learning by doing, is often a way to kind of more formalize that process and learn about it. And then we see some of those folks kind of say, you know what, that was a great experience. I'm so glad I did it, but it's more time consuming than I want. Or it wasn't as exciting to me because I really like just focusing on certain types of companies. And I'm going to go off and maybe do that back to friends and family investments. So we do some people kind of say, great experience, this is not quite for me. We also see other people kind of go on to kind of do the Seattle Conference again a second time. You learn a lot by doing things more than once. We see some people who then say, I want to go kind of join maybe one of the limited partner funds, particularly for diversification, which I think is a good idea if you want to move into that. And then we see also other people that kind of continue to build a network. They could develop a Seattle Angel Conference or elsewhere to say, I'll keep an eye out for syndicate deals, like an angel list. They'll say, wow, this is a great company. My buddy that I was with at Seattle Angel Conference 2 years ago said, you should really check this out. And together we did a syndicate deal specifically for that company. So they do one-off deals that way. And then in some cases, like with, I think Flying Fish and First Row Partners, we've had folks kind of go on to really start their own funds and be a fund manager. And at that point, you get to run the show the way you want. Typically, often as a fund manager, they'll take 20% of the carry. What that means is that 20% of whatever the fund is making kind of go back to the fund manager. So that's usually how they make the money. Some of them have fees and the like, but usually it's just what they call a carry. So all of these pathways are possible, and I think that there is absolutely no shame in trying and saying this is not for me. We've also seen folks like me that kind of start down the process, take a year off because I got really busy with something else and come back into it. So that works too. Now, what kind of returns do angels generally kind of see? This is some data that has been published. So basically a 22% return. That's pretty good. But the devil is in the details. And the detail of what you see here in the chart, 70% of angel investments basically lose money. And then you've got a small percent that make 30 times the return. So the big takeaway here is diversification is important. If you invest in one company as an angel investor, chances are you're going to lose your money. If you start investing in multiple, the big winners will make up for the losses to achieve the 22% or so return. Again, this is historical, but the 22% is a strong return. And so it has a place in your portfolio of investment if you can afford to get to diversification. And if you can afford to do it the right way. And that's what I'll come back to at the end of the presentation. What makes angel investors more successful than others? But even without looking at that, this is kind of historically what we've seen from the entire pool of angel investors. So with that, I do want to make a really strong note on diversification. So I said earlier, if you invest in one company, you're gambling. You invest in multiple, the big winners offset the losers. So what you see here, and I apologize for the small print, but basically this is on the bottom x-axis, it's the number of startups in your portfolio, and on the y-axis is your probability of return. So what you see there is you have one company, your probability of return of some kind of return, even a small one, may be 50%, but or even 70%. But if you get to about 20 companies, the number of big winners start to become such that your probability of having a positive return really starts to approach closer to 100%. So that's why thinking back to the journey, I want to encourage people when they think about angel investing, to think about it in a couple of stages. First, your first step is really just learn. Okay, you're going to maybe just get one investment out of learning. That's not a long-term winning strategy, but it will help you figure out, is this right for me? Is this something I want to do? If you decide that the answer is yes, then you've got to kind of commit to building a portfolio and diversify. Otherwise, you're just gambling. So this is where, you know, for some folks, wealth is important to consider, because let's say that I make $5,000 investment. To get that into 20 companies, I mean, 5,000 times 20, that's $100,000. It's a lot of money. That doesn't mean you have to do it all at once. You can spread that out over, say, 5 years, even 10 years. But if you start going that journey, you're sort of making a commitment to saying, yes, I want to allocate that much of my portfolio to angel investing. Otherwise, it's a high risk. It's a very, very high risk investment. I hope that makes sense, but I think it's a key point takeaway. All right. So day to day, what do I do as an angel investor? I would break it down into these elements. You develop an investment thesis. You find deal flow and investment vehicles, due diligence, and you assess your valuations and term sheet to decide what to invest in. So I'm going to try to break this down in a little bit into more plain English and so forth. Again, this is my perspective and vastly oversimplified, but these are the things that you have to feel excited or enthusiastic about doing. The first is you develop an investment thesis. What does that mean? That means that you have some clarity as to why you're investing and how you're prioritizing investment. There is no one way to do an investment thesis. It's a very common question that we get saying, what's a good investment thesis? Which investment thesis are the most successful? It's really an investment thesis is more a reflection of the investor's passion, personality, their own philosophy as to what made things successful. There's a guy named Javier who recently said something I really enjoyed, which is, if you look to the past to say, well, these investment theses were incredibly successful, they may not be that way anymore. So you have to be creative, forward-looking, read the economy, read what you value to decide really, where do I really want to prioritize my investments and what's going to provide a good return. And so it's always an evolving process, but to give you some idea of the element that can go into an investment thesis. It can be things like an industry focus. Some people might say, I really only like to invest in software as a service because it's fast, easy to get up the ground. I don't like investing in medical devices because there's a regulatory component and it's longer term. I don't agree. I love healthcare, but it's a valid investment thesis. Other people have impact in their investment. We're seeing this be extremely common these days, where they said, in addition to that, I want something that has social impact. I want to know that my dollars are going toward making a positive impact in the world. And so that can be a big part of it. Other people have investment thesis where they say, you know what, I don't know a whole lot of things about a lot of different industries, but I know a good team when I see one. So they start to think about things like, you know, there's a founder that has started the company just by themselves. And they kind of question, well, have they been able to attract other talent to kind of believe in their vision? What happens if they have an illness? What will happen to my investment and my money? So some people will kind of shy away from solitary founders, and that can be a valid consideration. Other people really like repeat founders that have proven a record. So they might say, I'm not even sure about the business model here, but I believe in this team. They've demonstrated something. Other aspects of investment are geographic focus. We see a lot of that. Essentially, people saying they want to invest in what supports the local ecosystem, their neighbors, the kinds of problems that they're seeing in their particular region. We also see investment theses that are based on risk tolerance. So some people are like, I just want a big home runs. You know, this idea looked like it could change the world or kind of replace Amazon.com. I mean, other people are like, I don't know, those are few and far in between. I'd rather have a little bit more of a certainty, something that is quite likely to succeed, but may only produce, say, 3 times a ton instead of that 30 times a ton of a home run. So again, all valid, but I think it's helpful to start thinking about those things, see where your gut feel, what you're comfortable with, and have it evolve as you go down your angel investing journey. The other thing angel investors do is due diligence. So another very common question that we get is, how do you do due diligence? Do a checklist? What things do I need to look for? So I'm going to answer that question, and then I'm going to tell you why it's not really very helpful. So these are some of the elements that you can see in a due diligence process. People want to kind of know what the team made out of, what the market, in other words, its size, its barriers to entry, its key drivers, things like that. They want to know about the product and service itself. How is it differentiated? Is it unique? Does it function well? They want to know about the competition, which can be a double-edged sword. Some people look at a lot of competition and kind of go, that scares me. Other people say it's real validation that there's something meaningful in this market. And if the product or service sufficiently differentiated to where I believe in it. Then you look at technology and intellectual property. You might hear the term the moat talked around a lot. So in other words, let's say you have a great idea for a great market. What protects other people from jumping in, copying it as soon as you achieve any kind of success? And so there have to be something unique or proprietary to what you're doing, or at least a first mover advantage. We look at marketing and sales. What's your go-to-market strategy? Are there people on your team who can execute that way? And then we look at financial. What's your cash flow? If you see a company that's burning a lot of cash and they're saying we want to make a raise, and you know they're going to need another raise in just a few months, that may not be a great sign. So looking at financials is also helpful. And so typically when an angel investor gets involved, there's what's called a deal room. A deal room is really nothing more in many cases than like a Google Drive that had documents to speak to one or more of these areas. Now, for those of entrepreneurs out there, I want to kind of also assuage you that typically a deal room does not have all of these elements. They have some aspects of this, and a good investor will understand that you're developing these things and will kind of prod and helps you move along that process if it's not already articulated. Okay, so now the real thing about due diligence that I want to kind of emphasize a little bit is, first of all, it's a process that's done with other people. If you do it alone, you can run into a lot of trouble for a variety of reasons. Number one, if we all have blind spots. So you look at something and you don't get a check on that, you can go down rabbit hole and kind of start believing an idea very quickly or disbelieving it. In fact, I mean, investors that know a space really well tend to overestimate the risk of that space. And investors that don't know a space well, they tend to underestimate the risk, kind of going, I've never seen anyone kind of create a garden, robot lawnmower. This is a fantastic idea. Turns out that it's not the first time it's been thought of or tried. If you know the space, or you might kind of see an issue that comes up with maintenance if you have an operations background. So when you work with lots of people, you get much better due diligence. And that's one of the advantages of investing with a fund or a syndicate, or like Seattle Angel Conference, where we kind of do it as a group. The second thing about due diligence I would emphasize is that it is an opt-out process, not an opt-in process. So it doesn't come when you say, here's an idea, and then the investors say, okay, let me do due diligence. Rather, it's like there's a pitch. The idea there to say, this checks out. I like what I'm hearing. There might be Q&A, there might be some informal communication, there might be a little bit of individual research, and then you go into due diligence process in order to say, let me see if I find any red flags here that make me go, actually, my initial intuition was a little bit not correct, or this is riskier than I thought. So it's a process of really kind of focusing in on what you think are the high-risk areas in what you've seen, and making sure there's no skeletons in that closet or things that you didn't understand. So that brings me to the third point here, which is that list that I mentioned is not necessary to give everything equal attention. Because due diligence is usually about focusing on the area that you think will make or break the company. So that's often highly company industry specific. And I will, for technology investments, I focus a lot on the IP, for healthcare as well. Where for consumer goods, I want to kind of understand the team and understand what the go-to-market strategy is. So your emphasis will vary quite a bit. I see I have the same point here twice in the slide. And then the third thing, and this is a little bit maybe a nod to our entrepreneurs in the audience here. Due diligence typically will run about 4 weeks and should be proportionate to the amount of investment made. So as an angel investor, I know I might be saying I'm putting $25,000 in this company. I really wanted to understand it really well. But from the entrepreneur side, they say, this is $25,000 in my $1 million raise. I can't afford to spend all my time babysitting this one concern. So I think there's consideration that happens on both sides. And a lot of the due diligence process is about the investor and the entrepreneur feeling each other out and saying, yeah, do I want to have a little bit of a marriage here? Because this might be a process that goes over 5 years. And the entrepreneur does not want to get in bed with an investor who's going to be asking every month for minute details. And then conversely, an investor doesn't want to get in bed with an entrepreneur who's not going to give them some basic consideration and time to reasonable questions about risk for the company. So the process itself is often a sussing out process of personality and fit. The other thing here that we have is talking briefly about valuations. So valuations are vastly, I think, misunderstood aspect of angel investing. Here's what I would say about valuation. When a company is an exit or a priced round, that means like a Series A, Series B round, you're talking about what is the value of the company? Is someone else going to buy it for that value? In angel investing, the valuation is more of a, this is what we think the company will be valued at when they do a price round. Because I'm basically writing a check that is going to convert to whatever that value is when there's a price round. Let me repeat that. So when there's a Series A round, someone, a lead investor, usually with a much larger check than the angels ever write, is going to say, we agree that for 10% of the company, this company is worth $50 million. At that point, that's what determined what the angels' investment ended up being worth, because their promise to get their investment converted to shares is done at the rate of the price round. So in angel investing, you can talk about valuation, but a lot of it ends up being kind of looking ahead to say, do I believe the company is going to be able to be valued that much when they go to play in the big leagues, raising a Series A? That's one aspect. The other aspect of valuations is that valuations are really I got this right, input, not an output. So what that means is that instead of saying, well, this company is really worth $40 million, you can think of it this way. You look at the company and you say, okay, for my $25,000 investment, I'm going to own 0.5% of the company at that valuation. Is that a lot? Is that a little? Am I comfortable owning that slice of the pie? And if the answer is that's too small of a slice of the pie, then the valuation is too high. If the answer is that looks like a good slice of the pie to me, then it's a good valuation. So sometimes valuation can be worked backwards in that way. That being said, there are some different methods that people use to try to kind of put some structure around valuations. I've listed some of them here. Revenue multiple, which is kind of taking the multiple of the revenues the company has. And discount cash flow, where you kind of have even a model that looks ahead. And if you believe in the model, you basically are kind of pulling back the profit over that period and then saying, well, that's what the company's worth today. You can look at comparables, other companies that have had a priced round and are in a similar space and say, well, that might be a reflection of the company. And then some people even use a point system. They say, well, management is worth this much. The idea is worth this much, et cetera. And they kind of come up with the value. A lot of VCs or funds will use multiple approaches to try to triangulate and to say, yeah, this is all pointing at the same valuation. We're comfortable with it. But one of the challenges with valuation for angel investors in particular is that companies may not have a lot of revenue. So revenue multiples don't work well. Discount cash flow, these are just projections into the future. So they're widely variable, so they may not be terribly meaningful. Comparable, particularly the idea of new and novel, may be hard to come by, it may not be exact. And so really, again, the valuations are more about, as I said earlier, you're trying to get a sense of, am I comfortable with how much of the company I'm going to own in relation to the investment I'm making? The actual valuation of the company happens later. And the final thing I'll say about valuations, it's easy to get fixated on going, is this the right valuation or not? But 100% success on a low valuation is going to be worth more to an investor than a 0% return on a very attractive evaluation. So as angels, we often focus more on, do we really believe the company has what it takes to succeed? And do I have a fair enough evaluation? And if the answer is, I don't believe the company has what it takes to succeed, it doesn't matter if the evaluation is very attractive, and vice versa. Okay. And then the last thing I think investors really need to focus on, they have to have some competency with term sheets. So this is if you invest with a fund, the good news is they take care of those details. If you do your one-off investments, you need to know what you're signing and what you're getting into. So I'm going to give you a high-level overview of what they look like. Term sheets for angel investors are usually what's called a convertible note or SAFE. A convertible note is really saying, I'm giving you the money as debt, and you can convert those debt into shares when you have a price round. A SAFE is simply saying, I'm giving you the money, and you can convert this into shares when you have a price round. So a little bit different. Convertible notes are a bit more common than SAFE, in part because convertible notes have certain rights if you're a debt holder, as opposed to just flat out share agreements. But in either case, it's a really high risk investment because an investor basically does not have a conversion or an exit or Series A. Your money doesn't go anywhere. It doesn't do any much. It's very hard to actually collect on the convertible notes, and there are generally no such precaution with safes. And then there's a bunch of other deal terms that are part of term sheet. The conversion terms, which will dictate when exactly does your convertible note turn into shares. There's a valuation cap, which is a way of saying, even though the price round will determine the value of the company, it will be at a certain limit, so that if the valuation ends up being super high, my shares won't be worth this much. It will be worth, a good percentage with the cap on what that valuation is. The discount sometimes applied to it. So in other words, they'll say, in addition to converting your money into shares in that next round, because you were an early investor, we'll give you a 20% discount on that. So you see that particularly with convertible notes, not so much with safes. And then there's a bunch of other smaller terms that you'll see, things like information rights, which is basically saying I'm going to have a right to get an update every quarter. There are some startups and some agreements where you basically write your check and you don't hear from the company. And you may kind of, knock on their door and say, hey, will you tell me what's going on? And they're like, you're a really small investor and they don't give you much of the time of the day. So information rights and give a fund manager essentially right to give regular updates. What's going on? The most favored nation rights, that basically says if you have another round with different terms, then that's going to apply to you as well if they're more favorable. Pro rata rights are right to basically say I have a right to reinvest. So in other words, I invest in the seed round, but when Series A comes around, I have a right to kind of double down my investment, if you will. So it's a way of kind of saying as you achieve success, I can get more skin in the game. So there's a lot that happens in term sheets, and I would say that most angel investors don't need to be deeply intimate in it, but eventually you get fluent with some of these terms so you understand what you're signing. All right, and the last section here is why are some angel investors more successful than others? I'm going to give you a little bit of data, and then I'm going to tell you what I think. So first, here's some data kind of showing that investors that spend more time in due diligence tend to have higher returns. That kind of makes sense, and there's a little bit of a self-selection bias here. The company to go into due diligence are often the ones that are already getting more attention because someone's already more interested in them, so they're more likely to succeed. But needless to say, having the time as an investor to do due diligence is can be important, or at least if you outsource it, you trust the fund to be able to do it. Relationship to industry, we have some relationship, but it's not, as you can see, a perfect relationship. I hear a lot of people that say investing what you know. That's true, but it can come at the cost of diversification. So if you invest in one industry, one thing only, I think there can be a downside to that as well. But as long as you invest in a group, that may not be a critical. Impact of participation, the more involved investors tend to have a better return, that they know what they're investing in. So we'll see that as well. My view is that two common misconceptions is that you really need a lot of in-depth industry expertise. Like you can invest in healthcare if you don't know healthcare. I don't think that's true. I think that lots of times people who come from inside an industry have very myopic views of things. And again, it's the group investing exercise and the network where you get the better insights. The other thing is you don't have to be a financial whiz. I talked about convertible notes, safes, and so forth. And yes, it helps you understand all of that. But more than anything, you're looking for companies that you believe are going to succeed. Whether or not they are a 5 times return and the discounted cash flow looks like this or looks like that, that's a lot of noise. Nobody can predict that with that much certainty. But if you believe in a team, you believe in an idea and so forth, the returns will prove themselves over time. You don't need to be a financial whiz. What I think you do need are the following things. You need to have a healthy level of curiosity. New ideas, by definition, are breaking the mold of what we think we know. So, so being able to kind of understand and look at a problem from lots of different angles and say, what about the operations of this? I love your idea of doing something to take care of a rural healthcare population. But what's going to happen is there needs to be maintenance out there. Do you have people that can kind of run out and fix the thing? Just being able to ask those questions goes a long, long way. And so you don't need as much in-depth industry expertise as you need to start developing a broad level of curiosity. Second, you do need time. It can be time consuming. The Seattle Angel Conference meets for like 2 hours every Tuesday for about 3 months. That's an intensive part of the experience, but if you start looking at lots of different companies and networking and meeting with companies, it can take up a bit of time. And that's why we see a lot of people do it in retirement age, or maybe when their child is not 6 months old, or in between jobs. It's very common for people to kind of get into angel investing at that point. But that being said, I do it while I'm still working full time because I'm passionate about it, and do it in the evening primarily. You have to have an appetite for networking. This is important for 2 reasons. Number one is what we call deal flow. Deal flow is like, where do you find different ideas and businesses? And often that's your word of mouth. I think there was something that someone who asked earlier, where do I go for real estate investors? The key really is to find one who's kind of working that space that might know another, and eventually you kind of find that. For networks, and the people talking to people talking to people. And the network also helps you with due diligence, to be able to kind of ping Elizabeth and kind of say, hey, I came across this healthcare company. What do you think? Am I nuts? And for them to kind of, write back and kind of say, I don't know, I think there's something here, and so forth. That can lead to a special purpose vehicle, a syndicate, to invest in that one company as a group. It can lead to the ability to bounce the idea back to somebody else and do some informal due diligence so that you can make your own investment. So networking is important. Diversification, I talked about that earlier. Long-term commitment to diversify. If you're not committed to diversifying your portfolio and growing it a little bit over time, you are much more in the realm of gambling. And then finally, I would say it's a certain amount of patience. I started in 2016, and I had 22 companies I've invested in. So I've achieved diversification. I have a portfolio, but most of my companies are still in that waiting period. They haven't failed, but they haven't succeeded either. So I'm patient. I hope I will see the 22 returns, but I have not actually seen what those numbers look like for me personally. So I hope this was helpful. And with that, I want to kind of stop the presentation, and I'm happy to open it up to questions if people have any.
Hey, Alex, you mentioned the time commitment, couple hours every week for 3 months. What happens if you aren't able to make that commitment through the whole process?
I'm sorry, what happens if you what specifically?
What is it? Is it something to not get into if you're not able to make that time commitment for the whole time period?
I appreciate the question. I would answer it this way. I mean, longer term, you can join funds where you can be a passive investor. So in other words, you're writing a check and that the fund manager by and large is investing in it. I'll give you an example. You know, I invest through Sea Change, and Sea Change will have regular meetings. They invite people to due diligence teams. But when I'm busy, I'm not participating. I'm just watching. The emails are coming through saying, hey, we have a vote and we think that this company is going to be one that we invest in. And I have not even read the first thing about that company, but my dollars are going to work there. They're going into that company. On the other hand, when I have a little bit more time, I raise my hand, particularly if it's a healthcare company, and I say, I'd love to be part of that meeting, to look into it. And I can dialogue with the fund manager and kind of say, here's what I'm seeing, here's what I'm thinking. And that can be a little bit more time consuming. So there is a range of what you can do, generally speaking. Now for Seattle Angel Conference, because it is a learning by doing program, it's very much looking at trying to do a 2-hour commitment a week, because we go through everything from screening an initial set of 50 to 100 companies to debating each other's investment thesis and learning about how that develops, to being part of a small 3 or 4 person due diligence team, to eventually kind of deciding one company to invest in. So if you're not kind of with that whole process, then it becomes disruptive to the learning process.
Okay, thanks, that's helpful.
Mm-hmm.
I would like to add there are different times through the process that the weeks are more intense than others. There are some times when the investors are spending a lot of time actually analyzing the companies. And then there are other times when the investors get a break because the founders are spending a lot more time doing their work to prepare for the next presentation. So for example, our cycle is we take 60 companies, and so an investor would need to be around to look at the 60 companies. And then we make a decision collectively to get to 24. And then once that decision is made, the next week after, the founders are spending a lot of time preparing and doing their presentation for the investors. And then the investors look at that new information and make a decision to get to 12. So it's a little bit of ebb and flow. You have to be pretty well committed to the whole time frame, because if you're missing out on some information about the company, and then you're not as able to contribute your opinion as to whether or not that company should move forward in the session. But we all understand that there's some normal, I may have to leave half an hour early one day, or but we would like people to be pretty well committed to the time frame, because it makes your educational process better and it makes the group decision making better. Does that help, Bill, or does it?
Yeah, that helps a lot. Just trying to think, if you miss one, then you not come in, because you're going to maybe miss 1 or 2 meetings through the next couple months.
No, we know that people will miss 1 or 2, and we actually always tape the meetings. The videos is available for the investors when the founders have actually presented, and then and so that is available for people afterwards.
If you are interested, I mean, I can show you the timetable. It's really more of a 4-week due diligence process. The people involvement tend to be the most intense and matter the most. What other question can I answer?
Hi, Alex. I had a question about, I guess, a little bit of the transition from seed to Series A. It seems like the rounds are changing all the time. The numbers involved start to blur together. Is there a real demarcation between the two? Is it just the convertible notes and the safes that dictate which one you fall into, or what are your thoughts there?
Yeah, no, I agree. I think, I mean, these are seed and Series A are usually just convention for really the type of investment they fall into. So typically a seed investment, I have seen, actually I had a chart before, I think half of the seed investment ended up being for shares, or priced round. So people's nomenclature does vary a lot. I'm looking at an investment right now that is a seed investment, but it's a $2 million raise. And they're looking to bridge to what they call a Series A round. And what makes it a seed investment is the fact that it's a safe, it's not a priced round yet. So that's usually the demarcation, but we see venture capital firms making seed investments, and we see angels actually in priced rounds, usually very, very high net worth angels. So it's not an arbitrary line there, but usually it is a distinction between a priced round for shares versus convertible notes. We'll see.
Thank you.
I don't know if Elizabeth, Elaine's been part of SAC for a long time. So do you guys have any perspective on this? Please feel free to jump in. I'm by no means the only expert in the room. We have a lot of wonderful talents on these topics.
Oh, Alex, I think you had a great description. I think also one of the things that I've heard that is becoming more commonplace now is kind of this, I'm going to call it mushy middle, called something like a seed plus, where the company is not ready for Series A yet, have not met the milestones that the VCs kind of need to get to that Series A piece. And it also sometimes is called a bridge round, where they need another round in between there to get to those milestones, to prove to the VCs that they can meet all of the metrics that those VCs are looking for before they put their money in.
That's a good point, because it makes me think that another way that the rounds are distinguished is by traction. I mean, if you're rolling and you're demonstrating lots of traction, then it's like we're ready for Series A, and you jump into a priced round. Whereas you can have conceivably multiple seed rounds where you're like, I'm having trouble raising money, but usually that starts to raise flat. So people are usually very mindful about saying when's the right time to start a round, because if I haven't shown progress from the previous round, whether you call it a seed round or not, then that's gonna look like you're just trying to struggle to raise money to survive.
Is there maybe a follow-up? Is there like an industry consensus on where to guide founders for an exit? Obviously going through the series process, multiple rounds towards an IPO, or that takes considerable effort, time, and money. What about an acquisition? Is there a preference there? What are your thoughts on that?
I understand the question correctly. It's like the almost a roadmap, and I would say no. It might be a little bit industry specific. Because, for example, in healthcare, you often need subsequent round. The whole process of going through these rounds is a process of de-risking the investment. So, in other words, early it's like high risk, and you're like, I need money, but I know this is high risk. And then you have hit a milestone where you said something's happened. It might be I achieved regulatory approval for something. It might be, look, I have more than 10 customers and I'm growing at this rate, where it's like, I can go back to investors now and I can say, look, this is far less risky than the last time I raised money. So I'm looking to get more at favorable terms and to move forward. And so the process of de-risking itself, at some point, the company had been de-risked enough to where it becomes attractive for an acquisition. So, I've seen healthcare companies where like, as soon as the first piece of clinical data comes out, a company wants to buy that. But they're like, I can see the market potential here. And so they may not go through a Series D. It might be pretty early in the process. Whereas others, they're going to Series D because in addition to demonstrating the clinical data, they need to raise a sales force and they need to get this out to market. And once they're getting traction there, a company wants to acquire them. So I think it can vary a lot, but the key point is that each stage you're getting closer to demonstrating to someone that your money doesn't have as much risk in it, and that becomes the point of acquisition. Well, I don't want to keep people here longer than they need to. More than happy to kind of answer questions offline, to speak to people about this further. So
I had a similar question, Alex, and you kind of answered it, but how common are buyouts before Series A? And is there any kind of, if you heard of any angel investors with a thesis of looking for companies that are acquirable before then?
I'm not aware of any specific data around that.
Or anecdotes is fine too.
Yeah, I think that the one case where I kind of have seen it happen anecdotally is that in the seed round, there might be a partner of some sort that is invested in the company's success. So they might say, yeah, I want to do a pilot, but I'm also now investing in this company, so I really believe in it. And then they're saying, yeah, we like what we've seen in the pilot, and they then kind of make an acquisition. It's not terribly common, and it's usually a very close alignment between what the company's doing and an early customer. I think where that happens.
Thank you.
Do people generally lead a seed round like they do in VC, or is that a little bit industry specific?
So they lead a seed round. So most of the round, all rounds have to have the same terms. And so there will be a lead investor that kind of is giving life to the round, so to speak. So in other words, if I went out as an entrepreneur and I said, I want to raise $1 million, and then I went to Elizabeth and I said, would you write a $25,000 check? It's going to be a little hard, because then everyone kind of going, well, I don't know. How much money have you already raised? Are you actually close to reaching your 1 million and so forth? Or they might kind of say, well, I like that, your idea, but I want a 20% discount. And so you're dealing with all this noise in terms of different types of interest and so forth. But when you get a lead, what's called a lead investor, it will be usually someone who's writing a fairly sizable check toward that goal that you want to achieve. So they might say, I'm putting in, $200,000 or $500,000. And at that point, two things happen. Number one, if the terms are set, that investor is happy with the terms. And so when you go to other investors, you're like, yep, these are the terms. So they're either on board with it or not. So there's lots of that noise that happens in negotiation. And then two, it also sends a signal. You're telling them, I'm raising $1 million. I've already raised half of it. You want to jump on board? And they kind of go, well, that person's in. I feel a little bit better about getting in and so forth. So finding a lead investor is one of the hardest things for entrepreneurs to do in general. But once they do, the ball gets rolling usually.
Are there any other questions? I'm looking in the chat here. I have actually put in a sorry. Regina, you asked how much of the social impact, sorry, I'm just quite, companies mean to angel investors. Do you want to ask your question a little bit more?
How much of the social impact company mean to? If I interpret the question correctly, it's very variable. I think I've seen even in just 6 years a huge rise. There are folks I talk to who will not invest in a company that doesn't have some diversity in their management. They just won't do it, period. And then there are other companies who will, other people who will say, I'm just focusing on ideas that I think will give me a good return, period. But we do have funds like E8 that are only focusing on climate change, for example. So, they have that as a starting bar. So we're seeing that more and more. It's almost like some minimum social impact bar that different investors have in the thesis. And then on top of that, they're going, do I believe in this idea? Can I make a good return to it for it?
And let me just put a plug in for Seattle Angel Conference. Alex, I think you did a great job presenting SAC. I have been an angel investor with STAC since round 7. And I can't begin to even describe how much I've learned over the years. And with each new round, I learned something new. So I'm very excited to be coming to the next round of SAC with Alex and Tessie and Austin. The journey of learning doesn't end. And I think some alumni from SAC move on to different groups. I have invested in other groups as well. But I do keep coming back to Seattle Angel Conference because, as Alex said, it's a learn by doing kind of thing. And it's just a fantastic learning experience. And one of the things that we do with Seattle Angel Conference is try and get a mix of returning angels and new angels so that the new angels can learn from the returning angels as well. It's just a great atmosphere. So I'm looking forward to next round, Alex.
Thanks, Elaine. Me too. I think there's a social component to this, which is a lot of fun. You get to see some of the same faces again and kind of build on a rapport with that and so forth. So it is a lot of fun. And even though you're only getting one investment out of it, I think if diversification can be thought of it going, it's not such shotgun approach, you know, how do I get all those investments at once? So like Elaine had built her diversification in part by kind of doing this for many years.
Exactly. Exactly. That is exactly, Alex, my goal. So by doing it that way, I have gotten over that magic 20 number. So part of what you say is be patient, and it's true because but you don't have to spend all your time at once to get that diversification. And yes, I have had returns. So it's been great from many aspects.
Right.
And so we think it's great for the investors. We actually, I put some information in here because we also think it's great for the founders. Everyone learns together and moves forward and becomes partners. And we just couldn't have had a more ringing endorsement this morning than a company that came through APIS and through SAC and said, you whipped me into shape. They just raised $2.3 million. And so we bought their products, we invested in the founders, and we are so excited that they have moved forward. So so investors won, founders won on this. And that's part of why we're doing this collectively, because we can champion each other and the people that we're working with more effectively. So Alex is going to be a great lead for SAC 22 and so excited to be working with him. And if there's anything I can do to provide some assistance, then please let me know. I've had a few people reach out to me in contacts. We'll draw it to a close tonight. If there's no other questions, please reach out to Alex. Please reach out to any of our other assistant fund managers and anybody who's on this call who's put their information in. If you've got a question about what you're doing and how you could connect, we're very much part of the community of investors. So Alex mentioned Sea Change, First Row. We have alumni in other programs, and we invite the other alumni to come in two things. One, in education, but also when we need to close a round. So if you need more money to close a round, you need some connections to be shopping the round to, and we help founders do that so it benefits the investors. So the investors know that if this company needs to get to this milestone to be successful, we want them to be able to raise the rest of their money. Just as Alex was saying, you know, how many other people have put your money in your $1 million? We want to be sure to be helping to get that $1 million or whatever number it is. Thank you for your time. This will be posted on the Seattle Angel YouTube, which we've posted in the chat again. And please feel free to watch it. It'll be up in the next couple of days.
Well, thank you so much, Lisbeth. And if anyone has any other specific questions, I have a real passion for that. It is a community. Feel free to reach out.
Great.
Okay.
Thanks again, Alex, for doing such a nice job for us.
My pleasure.
Thanks, Alex. Thanks, team.
Bye.
Thank you.